All investing is subject to market risk, including the loss of principal. Past performance is not a guarantee of future results, and there is no guarantee any investment strategy will achieve its objectives. This information is provided for illustrative purposes only and is not a prediction, projection, or guarantee of future performance. This podcast is provided for general and educational purposes only and is not intended to constitute legal, tax, securities, or investment advice or a recommended course of action in any given situation. All opinions and views constitute our judgments as of the date of production and are subject to change at any time without notice.
Welcome to the Rainmaker Podcast with your host, Gui Costin. The goal of this podcast is to give listeners a unique look into sales strategies from top industry executives. We introduce you to the heads of sales and heads of distribution who will help you understand the inner workings of the successful sales organizations from philosophy to execution. This podcast is essential for sales professionals seeking wisdom from the best in the field. If you're not familiar with Dakota and their Dakota Rainmaker content, please check out dakota.com to learn more about their services.
This episode is brought to you by Dakota Marketplace. Are you tired of constantly jumping between multiple databases and channels to find the right investment opportunities? Introducing Dakota Marketplace, the comprehensive institutional and intermediate database built by fundraisers for fundraisers. With Dakota Marketplace, you'll have access to all channels and asset classes in one place, saving you time and streamlining your fundraising process. Say goodbye to the frustration of searching through multiple databases, websites, Form ADVs, and say hello to a seamless and efficient fundraising experience. Sign up now and see the difference Dakota Marketplace can make for you. Visit dakota.com/Dakota-marketplace today. What is up, everybody? It's Gui Costin, founder and CEO of Dakota. Welcome to the latest Rainmaker Podcast. I'm joined by Danielle Brown from Altriarch, CEO, founder. Welcome.
Thank you. It was nice to be here.
So excited to have you here. So Danielle has been in the alternative asset management industry for nearly 25 years. Her career has spanned all facets of the industry, including manager, diligence and allocation, investment team and client-facing roles, as well as oversight of operational functions. At Altriarch, Danielle is responsible for day-to-day oversight of the firm's investment team, client development, investor relations, operations, and finance. Prior to Altriarch, Danielle was a managing director for Dyal Capital Partners, a leading GP stakes firm, from 2012 to 2020, where she played a key role in strategic planning at underlying portfolio companies. Prior to Dyal, Ms. Brown was the global head of client development for Roundtable Investment Management Company from 2010 to 2012. Prior to Roundtable, Danielle was a senior research analyst at Wachovia Bank from 2004 to 2010. While at Wachovia, Danielle was responsible for oversight of the bank's sub-advisory fund of funds relationship, which peaked at $3 billion in AUM. Danielle was a member of the Milken Institute's Young Leaders Circle from 2024 to 2018 and became a chartered financial analyst in 2008. She currently serves on the board of directors for the Ronald McDonald House of Charleston. Ms. Brown received a BA in Finance, magna cum laude from Seattle University. You have quite the background, so would you mind just giving us a little, where you grew up, college, and what you did after college?
I've jumped all over the place. I'm from Minnesota, so good Midwestern roots.
Nice.
Grew up there in Minnesota. Went to school on the West Coast at a small liberal arts school, Seattle University out in Seattle. We lived there for about 5 years and then made my way down to the Southeast. Very brief stint in Atlanta, but landed then in Charlotte, where I spent the bulk of my career. Over 20 years now in alternative strategies. That's all I've ever done. I've held most seats in the industry, from operational to investment team to client development and marketing. So my time in Charlotte was very formative for me. I was there from 2004 to 2010, 2011 timeframe. But then made my way up to New York and was most recently with Dyal Capital Partners, now Blue Owl, before starting Altriarch in 2021.
Yeah, and Dyal, an iconic GP stakes, the originator, right, of the GP stakes business.
Yeah.
Any learnings, takeaways that you've applied to Altriarch from your experience at Dyal?
Absolutely. I think when I started at Dyal, we had 3 stakes that we had done. We had barely closed. I don't think we had even fully closed fund number 1. And so it was a really fun, exciting time to be part of that team. We were growing rapidly, out fundraising, closing deals. And so by the time I left in 2020, I think there were over 42 stakes. So there was a lot of time to go witness different ways people ran asset management firms. It varies widely to see how they want to run their firm. So some of the things that I took away from that, looking at firms that I felt were successful, firms I felt had a good culture, was one, we wanted to create a sense of autonomy at Altriarch. We really wanted people to feel that they have the ability to grow and to run their own department to add to the success of our firm. And one of the ways in which we do that is every single person in our firm is an equity owner at the company to some degree. If you've been with us for a year and everything's in good standing, you're granted equity in the firm on the 1-year anniversary.
So when you talk about the variance of how asset managers, 42 that you experienced, were run, any things kind of come to mind, 1, 2, 3 that were like that stood out the most that probably wasn't good, that needed to be changed?
Capturing too much economics by one person, too much decision making by a handful of people at the top, and having, one of the bigger things that we saw is having an incohesive or uncohesive marketing message or a lack of strategic vision for the firm. I think a lot of firms really succeed when they stick to their knitting. You know, you really become experts and specialists within one particular avenue, and there's variations within those avenues, you know, but try not to veer too much. Try to be very consistent with your messaging to LPs, and kind of boils down to become expert at one thing and execute that very well.
What made you choose the strategy at Altriarch? Like, you could have chosen a lot of different strategies.
Yeah, that's a great question. And some of it was just the serendipity of meeting my partner, Megan.
Okay.
When I left Dyal in 2020, my most recent assignment at Dyal was working with a firm called Chenavari in London. Chenavari is a very interesting private credit shop, about $5 billion, public and private credit. They did a lot of esoteric private credit. I loved everything I was exposed to there, from factoring to bank reg cap trades to trade finance, and knew that when I started my firm, I wanted it to be within private credit. I think private credit managers have a real ability to add alpha, given their structuring capabilities, workout capabilities, and just the day-to-day operations of handling those loans. So I knew that. I knew I wanted to focus there. And when I moved down to Charleston, which is where we're headquartered, I met my business partner, Megan Brooke. Megan at the time was a portfolio manager at a company that did short-term business loans and factoring. And she was lamenting the challenges of finding financing for these specialty finance firms. Banks, the ones that do lend to the space, have very low advance rates. They tend to have a difficult time with the nomenclature and kind of in the niche and in the cracks where factoring and accounts receivable lives. So it's not easy to find financing if you're in that industry. Megan and I sat down and started to construct the strategy, and we realized, like, default ratios in this space, 2.5% to 3% for a lot of factoring firms. They're earning 24% on their equity. You have a lot of high barriers to entry. There's a lot of specialized knowledge to execute in this space. And I felt like that was really kind of checking the boxes of things that would be attractive to institutional investors. Consistent cash flow, low default rates, high barriers to entry. Those are all reasons you hire an asset manager to run that pool of capital for you. So we formulated that strategy over the course of 2020, officially launched our firm in 2021, and found our first investor at the end of that year. So we now have an over 3-year track record, and so far so good.
That's great. Could you describe the investment strategy, please?
Yeah, it's relatively straightforward on the face of things. Where it gets more complicated is when you get into the collateral analysis and the collateral monitoring and management. So what we do is we lend to other specialty lenders, full stop. We do that in 3 forms. You know, a senior secured, typical first lien position, 80% advance rates. We'll do it as a subordinated position as well. So that's behind a regional bank. We'll attach at that bank's advance rate. Maybe they're up to 70. We'll take that borrower from 70 to 90, or some circumstances up to a 95% advance rate. And then the third strategy is best thought of as doing a co-investment alongside that specialty lender in either a vertical slice or a horizontal piece of their portfolio.
So for me personally, just being much more of a distribution person than an investor, what I love about private credit is the alignment of interest. And I don't know how you feel about that, but to me, it makes so much more sense to have you making loans versus a bank, because the person making you worked at a bank and that's where you grew up. You could be in a different division. After you make the loan, there's no ownership. If it goes sour, it's not coming out of your pocket. If you guys make a bad decision, it's like you feel the pain.
And what we do is operationally intensive. The way that we do loans is our loans are not lend it and kind of forget about it and let it run. We're talking to our borrowers in some circumstances weekly. We're monitoring collateral weekly. We have a 5-person investment team and a 5-person collateral monitoring team. So they're constantly looking at that collateral every single day to see, are we fully secured? Do we need to talk to our borrower about some aging on a particular set of invoices that's starting to slip? Do we need to talk to our borrower about, oh, they had a client who declared bankruptcy. What's going on with this situation? So our loans are heavily operational lift for us as a team, but we like that because it kind of keeps the barriers to entry quite high, and it takes a specialized knowledge to execute.
That's great. So tell me about your distribution strategy. How have you guys gone about raising capital? And then give us are you on fund? Which fund are you on right now? Or
our funds are evergreen. So
evergreen.
We have,
okay, great.
So we've got 2 products. The flagship fund was launched in November of 2021. And I'll say because of what we do, because of kind of the specialized nature of what we do, our sales cycle is a bit longer than even normal in the industry. I mean, we already know it's about 2 years for a lot of LPs. Ours is probably a bit longer than that. Just because getting into the collateral analysis and understanding how we perfect that and how we recover when things go wrong takes a lot of time for LPs to really fully feel comfortable with. If limited partners haven't done specialty finance analysis before, or specifically accounts receivable and those tangential assets, it takes them a long time to get comfortable with the nomenclature and how we're talking about it. So we take a very educational approach to sales. We know that we're going to talk to potential limited partners 4, 5, 6 times before they even say, okay, yes, we want to move forward with in-depth IDD and ODD. So we have a lot of educational materials. We do a lot of proactive outreach. And Gui, we think about most of our LPs when they say, yes, we want to engage, we kind of spin up an internal project on all of those limited partners. Anyone who's been in our industry a long time knows that LPs touch every facet of your organization when they get into in-depth diligence. So we treat it that way, and that's centralized and controlled by our client development, Greg Antonelli, who runs that for us, and he spins up a project for an LP and assigns all the operational pieces to our head of ops, all the investment information to our investment team, and we run it like an internal project, trying to get information as quickly as possible to our limited partners.
And that's clearly because of the uniqueness of the strategy, that it's not like just off the shelf. It's so unique. So people's diligence, it's almost like they've never seen something like this before.
Some of the language too, some of the reports, we talk about things like dilution in the factoring world. A lot of people don't know what dilution is, but if you boil it down, it's essentially, you can kind of equate it to defaults or you being underpaid on an invoice and things like that. So you start to get comfortable with the language, and then we send you a whole bunch of reports from our systems that say, here's the dilution for this past quarter. They will now understand what that means. So it takes us a while to start to get them into that process when we send them the data room so they can understand it and not feel overwhelmed.
Yeah. And so you treat it like a project, each LP so essentially you do a bunch of meetings, and then when you get that serious interest, that's when the whole thing happens, right?
Yeah, I don't know if you're familiar with the software called Asana, but
of course,
we use Asana, and we'll spin that up, and we'll have literally every single thing that they've asked for and everything that we've sent them. And we can go back and click the links and be like, oh, we sent them the performance file as of December 2023. We'll be able to pull up that specific file and always reference historical information that we sent them.
Right. That's great. So you're leveraging Asana from a technology perspective. And did you say you're using, what is a CRM?
Oh, we use Affinity.
Affinity. Right. Yeah. Great.
From our size, we didn't feel we necessarily had the resources to devote a Salesforce admin to building out Salesforce the way that it really needs the attention to be built out.
Sure.
And we find Affinity works pretty good for our needs.
Oh, that's great.
Yeah.
That is great. So As it relates to, just comment on the CRM in general, the use of it, how powerful it can be, leveraging the technology, leveraging your time. Just would you mind commenting on that, just as it relates to the distribution process, maybe the sales process?
Yeah, absolutely. So Greg and I sit down every week and we kind of go over our top priority names and like what's next. How do we keep people interested? We also pull in Andrew Schaefer on our team, who does a lot of our marketing communications. And so we've been quiet now. We've had people who've generally interested, but we've been quiet now for about 4 or 5 weeks with folks. What can we produce that's informational, educational? What sort of aspect of what we're focusing on as a firm can we send out to continue to further that education? So literally every week we sit down and we go through those lists and we say, okay, what's top of mind? Who's the top priority? And then we find ways to re-engage with them if they've gone quiet. We hit that first. What's the low-hanging fruit? What can we complete this week that goes out to the investors?
So it's pretty cool how you created a very sophisticated strategy that takes a long time to get to know.
Yeah.
But it's also such an advantage to be able to be so deep in the education business, because that's really what it is. I mean, even for large cap, 22 stock large cap growth, US, that's what's kind of been our thing for 20 years. You still have to educate on, maybe less so today, but concentration. But you're really, really deep in the education business, which means once somebody gets to know you, they know you. Yeah. And they're going to stay with you, is my guess.
Yeah. Yeah. Right. And in what we do, there are always challenges. There's always one of our borrowers probably has a difficult client or a set of debtors who owe them that aren't really performing. So we're constantly working through those challenges. We've got a lot of interesting case studies that we talk to about with our limited partners about how we've helped our borrowers solve some of their underlying challenges within their portfolio. That's something that we really enjoy doing. A number of our borrowers are younger firms, so they're younger startups, and using us as a resource to double check their underwriting, to double check their collections process. We have legal resources that we can bring to the table at times. We're like, oh, you need to start sending demand letters, and here's a form that it should take, given the states that you're in, given your state regulatory environment. So we take a very hands-on approach with all of our borrowers.
Oh, that's great. Your history at Dyal gave you a look into the investment management industry that few people get, because you have such that level of depth. How has that affected your leadership style now that you're running your own firm? Everything that you've learned, because you saw a lot of 42 CEOs or maybe even more. Yeah. Right. Even if you're diligencing, how does that one, characterize your leadership style, but how much did that Dyal experience influence it?
That's a really good question. I smile because I spend a lot of time thinking about this. And in the beginning, I kind of had these ideas on how I wanted to run the firm. And then in practice, you realize it's a lot harder to run it the way you think you should on paper, right? So I always said that. So tell me, what was that? Yeah. So I always said that, if I had my own firm, I wanted to be able to give people the autonomy that they needed to make their own mistakes and to learn and to really say, I think this is how we should do it, and for me to be supportive of that. It's a lot more fearful when it's your own money on the line and it's your own company, and you're like, oh, you kind of want to control a lot more. So I'd say when I first started the firm, the first 1.5 years to maybe 2 years, I probably micromanaged too much and was trying to do everything. And then it reached a point where the volume of our work from a limited partner perspective, the number of borrowers that we were trying to evaluate, the quality of diligence that we were doing, I simply couldn't keep up, and it kind of broke the system. But that was a really good thing, Gui, because when that happened and I just had to finally let go, it really let me see how much the team can shine. And so they kind of wrested that autonomy from me. And now I've realized that they have complete control of their fiefdoms, of everything that they're focused on, and I don't worry about it day to day. And I realize now that my job is just to support them. What do you need? I try to ask more questions than give advice, like help them think through things. And so to me, that's a bit of my leadership style. I want them to feel confident in their decision making. And I think being the sounding board for each of my senior team members is probably the best thing I can do for them.
No doubt, because everyone wants trust. They want to be trusted, right? And autonomy. Yeah. What is trust but verify, right? Because you can't. Yeah. Right. Naturally, but being two in there, it essentially tells them, hey, I don't trust that you can do your job. Yeah. And then good people leave if that happens, right? They want to be trusted.
Well, and one of the other things that we work hard on culturally at the firm is it's okay to make mistakes. We worry about big mistakes, right? That's what we really focus on, is like, let's avoid anything that could be a really big mistake.
Yeah.
But the small mistakes, we're all going to make them. Maybe we're going to lose an investor because the meeting didn't go well, but we can sit back and say, what should we have done differently in that meeting? How should we have answered those questions differently? Or should we have redirected the questions maybe into something more constructive? I've got the benefit of almost 25 years in the industry of pattern recognition, of sitting in these meetings and dealing with LPs and portfolio positions. My team largely doesn't come from this industry. Some of the investment team members do. My senior partner, Megan, doesn't. She comes from the operating side. And so for her and others on the team, getting that pattern recognition that we're also accustomed to in asset management is something that's still developing. So we're going to make small mistakes like that, but that's okay because we've got a fantastic culture and everybody's growing together.
And it's funny you say pattern recognition, sophisticated way of saying, I call it telling people what they want to hear. Right?
Yeah.
Right.
Yeah.
If you're in an investor meeting, you better, like, after experience, you know exactly what they want to hear to de-risk the conversation. Every word out of your mouth is like, it's either de-risking or it's creating more risk. And if it's creating more questions, right? And then there's that art form.
I have this general rule of thumb, and I've actually not told anybody this before, Gui, but you get three bumps in the road with an LP. It's like if you create 3 openings or have more than 3 things that require explaining, it's done.
Love that.
So it's kind of like that pattern recognition. You get to the point where you're like, oh, that was the first thing I misstepped. I'm going to have to go back and explain that later. Yeah. And going through that, you maybe have 3 of those with a limited partner.
Well, I mean, a lot of people don't realize when you're sitting across from someone, you're asking them to take career risk.
Yes.
By investing with you and potentially get fired. And a lot of people are compensated on the investments decisions they make. Yeah. Right. In an allocator. Yeah. And so it's like, I always say you're playing with fire. So you have to be super prepared and understand and be able to anticipate every question. And there's some zingers you probably get, but at the end of the day, they do probably fall into some, right, 80-20 rule of how it's going. All right. So characterize your team a little bit and then tell me, what advice would you give a young investor getting into the industry today? Yeah.
So we have a young team. I'm the oldest person at the firm at 44. So we have a young group. From a distribution perspective, so a young client development person in particular, I would focus on educate, don't sell. Make sure you're well versed enough in the top 5 positions of the portfolio that you can talk in some detail about those. So make sure you're educated on the positions and the execution of the strategy.
So knowing the knowables, that's what.
I like that.
Know the knowables,
I like
right?
that, knowing the knowables.
Because even if you're inexperienced, you can know the knowables. You can know the ticker symbol, you can know the top 5 positions, you can know the investment case for each one of the top 5 positions. That's right.
And then focus on just helping your LPs get comfortable through an education process instead of trying to sell all the time. And the other thing that I learned early on that I really like, it's a little cliche saying, but keep the ball in your court. So when you send an email, a follow-up email, you've had a great call, you send an email, don't leave it open-ended with expecting that limited partner to come back to you. They're busy. A simple example of that is attached to the materials we talked about, really looking forward to connecting with you again. I will follow up in 2 weeks. That way you're still the one who's responsible for keeping that ball moving forward, and just keep that responsibility with yourself. Don't throw it out to the ether and wait for somebody to come back.
I couldn't agree more. So a lot of people ask me, Gui, what's your advice for following up after meetings? I said I recommend not following up after meetings. I recommend following up in the meeting. So I don't know if you've done this, but a guy called me and he did 20 years at in Austin, public pension fund. So we got on the phone. I go, how many meetings did you do with investors? He goes, geez, 20 years, 10,000. How many people asked you this question to close out a meeting? He goes, what's the question? I said, well, it's 2. It's like, hey, I really enjoyed the call. Is this a strategy that you guys could ever see existing in your asset allocation model? If they say no, you know what the follow-up is. Yep. If they say yes, then you say, hey, well, you're open-ended. So then you say, well, do you anticipate doing a search in private credit in the next 12 months? If they say yes, right, then you can say, can we be included? Yep. If they say no, then what ends up, we had to do this in 2011 because I was getting great meetings. Mm-hmm. How's the meeting? Great meeting. I'm like, well, did they wire money? Is that why it was such a great meeting? Like, just give me the status. I can take the bad news, right? So we always talk about that. And I'm sure for your strategy, if people are like, It's like, hey, is this something you could ever see investing in? I had one of our biggest Dakota fans. I told him this story.
Yeah.
Out in California, in a meeting, the big public pension fund brought in kind of an esoteric infrastructure. So interesting. The guy was all over it. He loved it so much. Chris asked the question right at the end, and the guy goes, no, I'd never invest in straight like this. Chris goes, then why did you take the meeting? He goes, man, I was interesting. I was just sounded so interesting. Yeah. And we can't do interesting meetings. You know what I mean? But but just, so then all the waiting game and the ghosting and all that never exist. If you do, now you're not going to always get the perfect match of, but sometimes a quick no is great. So
quick no's are the best.
Yeah. There's favorite.
Tens of thousands of potential investors, and if they're not interested, it's great to know, because we're not going to continue to pester them. We'll just keep searching.
I mean, I love the quick no. And it's just easier right there. It's like, look, I think it's a great strategy, but it's not going to be a fit. Okay, cool. But we had to have the meeting to learn about the strategy.
And then I would still say, that's great. I'll follow up with you in 6 months to see if that's changed.
But that's what I say to everybody. It's like, we have this amazing database of LPs and all this information, just oodles and oodles and oodles of information. But I'm like, appetites change. Like I can't tell you every minute, what someone's gonna be thinking about, what they're gonna like, not like, it's like, so you have to like touch base with people.
Yep.
Right. I mean, you're doing all the right stuff. Okay. Last question.
Yeah.
So number one, congrats on all the success, the company, everything, but tell me your biggest challenge that you're facing today in the market today.
There's the constant mismatch of LP inflow and opportunity demand. I don't think that challenge is unique to us. I think managers have talked about that challenge into perpetuity. Like very commonly investors come into a fund after a series of good performance numbers, but that's because the opportunity for the strategy maybe was really great during that period in the past.
Right.
So for us, tying that and getting that to match is always a challenge. Right now, our pipeline for deal opportunity is massive. We're seeing $35, $40, $50 million deals, and we've got enough capital to fund those. Thank goodness to our large limited partners that we currently have who are hungry for co-invest. So we'll hold maybe $15 million of that position in our fund, and the rest is out through co-invest with our LPs. But we need more limited partners in the fund, more mid-sized limited partners. We're anchored by large, notable institutional limited partners because of my history with Dyal. That's my Rolodex. Those are the relationships I brought to the firm.
Yeah.
We're working really hard to get the $3, $4, $5 million size limited partner into the fund, where we can start to hold more of those deals in the fund and less in co-invest.
Great. Well, thank you so much for being on the podcast.
Thanks for having me.
Yeah. It's a remarkable story. I'm so happy for you. Starting your own thing is not easy.
No.
Right? It's a personal exploration, if you will, mental, physical, everything, but congrats on starting it.
Thank you.
And thanks for being
appreciate
on.
that.
All right. And that is a wrap for another episode of the Rainmaker Podcast. Thanks so much for joining, and I can't wait to see you on the next episode of the Rainmaker Podcast.
You can find this episode and others on Spotify, Apple, or your favorite podcast platform. We are also available on YouTube if you prefer to watch while you listen. If you would like to check up on past episodes, check out our website, dakota.com. Finally, if you like what you're hearing and seeing, please be sure to like, follow, and share these episodes. We welcome all your feedback as well. Thank you for investing your time with Dakota.
Hey, thanks so much for joining Rainmaker Podcast. Hope you enjoyed the show, enjoyed the interview. I know I loved it. And hey, if you wake up in the morning and you raise money for an investment firm, you do cold outreach, whether you're a sales leader or salesperson, and you don't know about Dakota Marketplace, we would love to show it to you. It's world-class. It's used by over 880 investment firms and over 3,600 individual salespeople. To learn more, go to dakota.com and click on a free trial.